Good morning, good afternoon, and good evening, wherever you are in the world when watching this webcast. Welcome to the third of the three webcasts on the Exposure Draft Subsidiaries without Public Accountability Disclosures. The Exposure Draft was published by the Board in July 2021 and sets out a proposal for a new IFRS standard that would permit eligible subsidiaries to apply reduced disclosure requirements when applying IFRS standards. I am Carlo Pereras, IASB Technical Staff and Project Lead. I am joined here today by another member of the project team, ISB Technical Staff, Hazira Hasni. This is part 3 and the final webcast on our series for the Exposure Draft. In this webcast, we will explain how the draft IFRS standard is structured and how to apply it. As part of this series of webcasts, we have explained the objective and scope of the draft IFRS standard and how the proposed disclosure requirements were developed. And with that, Hazira, can you explain how the draft IFRS standard is structured and how to apply it?
Sure, Carlo. The draft IFRS standard is a disclosure-only standard, so no recognition, measurement, and presentation requirements are proposed. An eligible subsidiary that elects to apply the draft IFRS standard would apply the recognition, measurement, and presentation requirement in other IFRS standard, but not the disclosures that are listed in Appendix A. Appendix A of the exposure draft lists the disclosure requirements in IFRS standards replaced by this draft standard. A subsidiary electing to apply the draft IFRS standard applies the disclosures in the main body of the draft standard. The disclosure requirements are organized by IFRS standard. For example, all disclosures about first-time adoption of IFRS standards are located under the subheading IFRS 1. All disclosures about share-based payments are located under the subheading IFRS 2, and so on and so forth. Now, let's have a quick illustration of applying the draft IFRS standard. For example, accounting for inventory. The subsidiary would apply IAS 2, the IFRS standard for inventories, to determine how to recognize, measure, and present items of inventory. Then, it would apply the disclosures in the draft IFRS standard to determine what information should be disclosed. As I said earlier, these disclosure requirements are set out under the relevant subheading, in this case, under IAS 2. Now, in this particular example, all disclosure requirements about inventory can be found in the relevant subheading of the draft IFRS standard. However, in some cases, other disclosure requirements in other IFRS standards apply. Generally, these disclosure requirements are included in the draft standard as a footnote to the subheading of the IFRS standard to which they relate. Put another way, a subsidiary is exempt only from the disclosure requirements listed in Appendix A of the draft standard. If a disclosure requirement is not listed in Appendix A, then it is required and remains applicable. Those disclosure requirements not listed in Appendix A have been left in the IFRS standard, as it's best to leave those disclosure requirements in situ for context. For example, the disclosure requirements about going concern in IAS 1 are only required if material uncertainties to continue as a going concern exist. That particular disclosure requirement is left in IAS 1 because other paragraphs in IAS 1 provide further guidance about it. In other words, even if this disclosure is not listed in the draft IFRS standard, as this is not in Appendix A, it is still applicable. Moving on, let's talk about some frequently asked questions about applying the draft IFRS standard. First, the compliance statement. It is proposed a subsidiary electing to apply the draft standard states that it has applied the draft standard, and this disclosure is located in the same note as the statement of compliance required by IAS 1. This is to aid understandability and comparability. For example, let us assume a user is comparing financial statements of two subsidiaries, subsidiary A and subsidiary B. Say subsidiary A applied IFRS standards and subsidiary B the draft IFRS standard. Although amounts reported on the face of the primary financial statements would be comparable, the information disclosed in the notes might not be. The disclosures in Subsidiary A's financial statement would most likely be more than that of Subsidiary B. Second, maintenance. If the board finalizes this draft IFRS standard, it will need to maintain the standard when new or amended disclosures are introduced in IFRS standards. The board has decided it will consider amendments to the subsidiaries without public accountability standard when it publishes an exposure draft of a new or amended disclosure requirement for IFRS standards. This will facilitate consideration of the appropriate amendments to the draft standard. At the same time, the related amendments to the IFRS standards are being discussed. Moving on to transition to the draft IFRS standard and its interaction with IFRS 1. The proposed standard has no specific transition provisions. This is better explained as we discuss the draft standard's interaction with IFRS 1. If a subsidiary already applies IFRS standard and elects to apply the proposed standard, as illustrated in the left diagram, then those financial statements are not the subsidiary's first IFRS financial statements. Therefore, it would not apply IFRS 1. However, the subsidiary might need to restate some comparative information to be consistent with information reported in the current period. The subsidiary would also be required to disclose that it has applied the draft standard. In contrast, if a subsidiary previously applied a reporting framework other than IFRS standards, as illustrated in the right diagram, then that subsidiary would have to apply IFRS 1, as these are its first IFRS financial statements. IFRS 1 sets out requirements that a subsidiary has to apply in its transition to IFRS standards. One thing to highlight is, even though such a subsidiary would apply IFRS 1, it would apply the disclosures in the draft IFRS standard set out under the subheading IFRS 1. Considering the interaction of the draft IFRS standard with IFRS 1, no additional transition provisions were proposed. Now that we have covered transition to the draft standard, let's consider comparative information by considering an example. First, let's say we have a subsidiary that is applying the draft standard for the first time in the current period, but not the preceding period as illustrated in the left diagram. The subsidiary would have less disclosures in its current year financial statements. In this illustration, 20x2 compared to its 20x1. In its 20x2 financial statements, the subsidiary would need to provide comparative information only for information reported in 20x2. For example, if there is a disclosure required by IAS 19 that is not required in the draft IFRS standard, that disclosure need not be included as comparative information in the subsidiary's 20x2 financial statements. On the other hand, let's say we have a subsidiary that applied the draft standard in the preceding period, but elects not to apply it in the current period. This is illustrated in the right diagram. That subsidiary would have more disclosures in its current year financial statements, 20x2, compared to its 20x1. In its 20x2 financial statements, the subsidiary would need to provide 20x1 comparative information for all information reported in the current year. Following the previous example, if there is a disclosure required by IAS 19 that is not proposed in the draft IFRS standard, that disclosure will be required as comparative information in the subsidiary's 20x2 financial statements, even if the information is not disclosed in the preceding year's financial statements. And with that, we have now come to the end of our webcast on structure and application of the draft IFRS standard. Let me now hand you back to Carlo.
Well done! Thank you, Hazira. The exposure draft is open for comment until 31st January 2022. For more information about the project, or if you want to submit a comment letter, please visit the project page on www.ifrs.org. Again, this is the third of the 3 webcasts for the exposure draft. As part of this webcast series, we also have webcasts on the following topics: the objective and scope of the draft IFRS standard, and how disclosure requirements were developed. Thank you everyone for listening to this webcast and for your interest in this project.